Okay, so company A. Okay, I'll just read this. Company A owns all the capital of company B. Paid 2 million for the investment. 2 million has been paid. The share capital, the equity of company B on the 1st of July, obviously when the shares were acquired, was 1.3 million, share capital and retained earnings of 300. Okay, so what are we going to do? We're going to put 1.3 here. Okay. We've got 300,000 here. And we've got
210. Investment 2 million.
Okay. Okay, so I'm filling in these figures, but really I shouldn't be starting there, shouldn't I? Yeah. Okay, so let's go. What's the figure here?
300.
300? Okay, deferred tax?
90.
90. Still done. And the revaluation reserve? Okay, we then bring this down here. We have 210 here. Investment in subsidiary? 2 million. And the goodwill will be? 190. Okay. Okay, let's put a bit of a spanner in the works now. Okay, so we're happy with that. Okay, so we've got share capital, 1.3. Retained earnings, 300. The investment, 2 million. Okay, we've done this journal entry. We know that we had to revalue our land. And we don't take this figure, we take the equity figure because we're only dealing with the subsidiary's equity at the day that we purchased those shares. Okay? So we take this figure and we bring it down here. So now we've got the total subsidiary's equity. Okay? We paid 2 million, so therefore there must be goodwill of 190, which is obviously the difference between what we paid for the investment, what the parents paid for the investment, and what the equity was of the subsidiary at the date that the shares were purchased. Obviously we've adjusted for the land to be at fair value. Okay. So the subsidiary's assets must first be adjusted to fair value. Okay. We then make sure that the revaluation reserve is correct, and then we work out goodwill. Okay, happy with that? What if I now said to you that Company A acquired, let's say, 60% interest in Company B?
So 60% of the
Okay, so let's say paid, not 2 million, it paid, in fact, 60, quite right. We should rather do that. Okay, so what if I said that? How do you think the journal entry might change?
60% of 60% of
the share capital, retained earnings.
Okay, so you're quite right, you're on track there. This journal entry won't change. It won't change this. Okay, that's going to be the same. So we're going to, first of all, revalue the land to its fair value. Okay. The next thing that we're going to do, okay, is we're going to obviously debit share capital with what amount? It'll be 60% of that. So what's that going to be? 60% of 1.3.
It's 780,000.
Okay, 780, thanks for that. Happy with that? 60% of 1.3. Yeah?
Yep.
This one here is going to be 60% of 300, which will be
180.
180. Okay. Happy? Revaluation reserve will be 60% of that. 210. 60% of 210, which is
126.
126. Good. Okay, our investment in subsidiary is going to be 1.2. Clear. 1.2 million, and the goodwill is going to be the difference. Okay. The goodwill is going to be that minus all of those, as it normally is, which will be
114,000.
okay, 114. Yep. Okay. What actually happens, and I want to just bring you to, what basically happens is that in our balance sheet, what we have is we have total assets of subsidiary and parent. We have total assets, well, obviously excluding any intercompany obviously we will exclude intercompany transactions, so we'll exclude any kind of, if there's been a sale taking place between the two. Okay. We then basically show, what we show is we show the total equity.
How come you've got total assets?
Oh, sorry, total liabilities, thank you. And that's going to be 100% of the subsidiary. 100% of the subsidiary. So we're going to show total assets of S&P, 100% of the subsidiary, 100% of the subsidiary. When we show total equity, we've got to basically show what belongs to, so we go 60% plus parent, and then we show the non-controlling interest separately.
40%?
Is it 40?
Oh, sorry, 40%. Golly, I'm really on the ball today. I'm thinking tax rate, aren't I? Okay, so total equity, basically what we do is we show 60% of the subsidiary plus the parent, and we show the non-controlling interest separate. So what I'm saying to you is that when we do this journal entry here, we don't take 60%, we take 100%. Okay? But when we do, so what we've got here is we've got the 60% of the equity. Okay? And what we're going to have is we're going to have an additional journal entry. Okay? Don't get panicked if you're now finding this a little bit challenging. Okay? This is the first time you've heard of it for some of you. So we've got 60% here, right? And now what we're going to have is another consolidation journal adjustment, which is dealing with the NCI portion, or the non-controlling interest portion. So we're going to have debit share capital with the 40%. We're going to have debit retained earnings once again.
Where does this sit in the parent books? Or not?
Okay, the worksheet is a bit different when we're dealing with non-controlling interest, and I'll show you a worksheet here. Okay, debit revaluation reserve. It's not too difficult actually, once you get doing a few examples. I'm going to debit goodwill as well, and I'll show you what to do there. And I'm going to credit what we call a non-controlling interest account. Okay, what I'm doing here is I'm using the fair value method. Okay, this is the method that's the preferred one. There are two methods. The other one is the proportionate method, and I'll show you that just now. Okay. In fact, what I'm going to do is just show you the proportionate method first. Proportionate method, you can use, if you're an accountant doing this kind of journal entry, you can use either the proportionate method or the fair value method. This one is considered to be more conceptually sound.
Is it one or the other? Sorry.
Yes, one or the other. Yeah. Okay. First of all, I'm going to show you the proportionate method. Okay. Okay. So what the proportionate method is going to be, I'm going to go 40% of, what was the share capital? It was $1 million, wasn't it? No, it was
1.3.
1.3. Okay, so 40% of 1.3 is going to be
520.
520. Right. Okay, 40% of whatever the retained earnings was, and I shouldn't have taken 120. So it was 40% of 300, wasn't it?
Yeah.
Okay, 40% of 300.
It's 120.
Revaluation reserve,
84.
84. So obviously that's going to be 40% of this here. Okay? Okay, with the proportionate method, we're not going to have this. And all we're going to do is we're going to debit non-controlling interest. And that's going to be that plus that plus that. Okay, so 520 plus 120 is 640, plus 84 is something like that.
720.
Okay, that's the proportionate method. Okay? Okay, fair value method. What we need to do with the fair value method, we have to calculate the figure for this here. What I'm going to do is I'm going to leave that, leave that, leave that. So looking at the fair value method now. What we're going to do is we're going to say, if we paid 1.2 million, okay, for 60% or 0.6, what would we have paid for 40%? Okay, so if we paid 1.2 million for 60%, what would we pay for 40%? Has anyone got a figure there?
480,000.
Okay, so I'm going to put that figure here. Okay.
So you work backwards, would you?
Yeah, I guess you could say that. So we got 480 here. And then we actually work out a goodwill figure or a discount, whatever it will be. So if you actually, if you paid 1.2 for 60, that doesn't look right actually, sorry. Let's try it again. 1.2 divided by 0.6.
Oh,
Okay.
oh, divide by 0.6 and
Yeah.
multiply by
0.4, yeah.
800,000.
Okay, so you got 800. Yep.
Sorry.
That's okay. Mistakes are the best way to learn. Okay, so credit non-controlling interest 800. So if we go 800 minus that, minus that, minus that, we're actually going to have goodwill here. Basically what we're saying here, the reason why it's better is because you're saying, okay, if someone paid 1.2 for 60%, then obviously the goodwill of the company is not only 114, it's actually more than that. So this is only 60% of the goodwill. Do you know what I'm saying there? Okay. So basically 800 minus 520 minus 120 minus 84, it's 76, yeah. Okay, so the total goodwill is in fact, what we're saying is really if someone was willing to pay 1.2 for 60%, someone would pay 2 million for 100%. Okay, so and obviously that means that your goodwill is in fact not 1114, it's actually 200. Does that make sense? Okay, any questions? This should be relatively straightforward. All it was 40% of the total share capital at acquisition. This was 40% of the retained earnings at acquisition. This is 40% of that figure, right? We've worked this figure out, okay? If someone paid 1.2 million for 60%, what would they pay for 40%? Okay? And that's where we get the 800. Okay, so we got 800,000 there, and then obviously this is going to be a balancing figure. Okay. Okay, what I'm going to do now is just give you an example. I think we've heard enough. Any questions? Not expecting that you obviously understand all of this straight away.